much for coming along today, and especially thanks to those of you that have travelled a long way to be here. It's much appreciated. Mark is going to begin the proceedings in just a moment with some opening remarks, and we'll then hand over to Aziz and then to Aubrey for a performance and portfolio overview. And we'll then move into a question and answer session. During this session, we'll alternate between questions sent across in advance and questions from the floor. And we will finish at 4:30. And that's about everything from me. So without further delay, I will hand you over to our Head of Investor Relations, Mark.
Right, thank you very much, Sophie. And I'd like to echo Sophie's expression of gratitude for you coming here today, especially those that have travelled a long way to be here, and also some people who are here for the first time as well, including me, having only joined in November of 2018. And when you join a new firm, especially when you're tasked with representing the philosophy and the strategy to a much broader audience, the first thing that is important to do is to really understand what's driving that philosophy and what's driving that process. And the best way to do that is to understand the philosophy and the process and what's driving that. And I think the best way to understand Mayar is really to understand the genesis of the firm and Aziz's story, because at university he decides that, yes, he wants to be a portfolio manager. And I guess what normally happens in that regard is that people graduate, they find an internship, they find a graduate training program, they're an analyst for a number of years, finally become a portfolio manager, after a few years decide that maybe they can do it better themselves, and then launch a firm. But Aziz didn't do that. He skipped about 15 years of those stages and overconfidence and launched his own fund. And that's I think that's very important to understand why I believe that investing with Mayar is a great thing, because we talk about partnership principles, and these are essentially the constitution of the way in which Mayar interacts with its clients and its partners. And because Aziz hasn't been through that whole corporate machine, these are genuine expressions of both his ethical, personal, and investment principles, all of which are indivisible and run throughout the DNA of Mayar. And so these aren't, say, marketing, focus groups, principles. These are the ways in which Aziz and more broadly us at Mayar want to interact with our clients. So we're talking how we communicate, straight talk, being honest about what we can deliver and also what we can't deliver. Aligning our interests with yours, and so the performance of the fund and your experience as Mayar partners reflect our experience as Mayar. And when we think about risk as well, we want to take the risks that we as a firm are comfortable with, and also that you as our partners are comfortable as well. And one of the more important things is that only the long term. And when we think about long-term investing, that's something that, if you know the process in great depth, that's something that both Aubrey and Aziz focus on very, very closely. And actually, being a boutique asset manager as we are enables you the freedom not to think about what's going to happen in 1 or 3 years' time, but to look much further into the future, be able to take decisions that aren't reflective of the current market environment, but think about investing in businesses that will endure and deliver returns over a much longer term. And to a large extent, we kind of, in the past, have relied on our clients having a similar outlook. But earlier this year, in fact on February the 14th, Valentine's Day, in an expression of love to our clients, we launched something called the Loyalty Share Class. You're eligible for the Loyalty Share Class for additional subscriptions after you've been invested in the fund for 3 years. So additional subscriptions qualify for a Loyalty Share Class, which attract a much lower management fee of 50 basis points, plus a performance fee of 14% above the hurdle. And we think that fully aligns all of these partnership principles with that of our clients. So we're fully aligned both in terms of how we speak, the risks we take, and our long-term view. And the investment philosophy as well, one of the reflections of Aziz's ethical approach is the mental model in which we apply to owning businesses. We don't think about stocks, and bits of paper that are in a drawer. We think about partnering with businesses over the long term. And that means that the ethical way in which these businesses behave, their intrinsic value, the investment case are indivisible. And we think about all of those things together. And sometimes we need to dig much deeper into an investment case, and the applied behavioural science that is key to our process includes some of those ethical and investment principles as well. So once again, we see that how intertwined and integrated the ethical dimension is to the investment one. And then finally, we think about what we call a probabilistic approach. One of the lessons that I learned very early on in my career is never trust a forecast with a decimal point, especially your own. Because what it can do is give you a much, Aziz mentioned it earlier, you can be overconfident. If I tell you that the market's going to be up 24.34% in the next 3.5 weeks, that sounds very precise. But it's a false precision that gives you a misplaced confidence. But if you can become happy with ranges where, I'm happy to own a business where the stock trades between £2.50 and £3, that can give you that can allow you to consider much greater ranges of outcomes without relying on that false precision. And all of these things, again, intertwine. I'm trying to emphasise that the philosophy, both investment, personal and ethical, are fully integrated into the way in which we approach investing. Now, because of the, Aziz has mentioned many times in the past the ethical dimension to it, and in some cases that means there are just certain sectors in which we don't invest, including weapons manufacturing, gambling, alcohol, and so on. But there's a key phrase that I think is very important here. Any other activities determined to be unethical by the manager. And today, this has a label that's actually quite useful commercially and to differentiate what we do and reflect what we do in a way that clients are looking for. And at the moment, it's called ESG, Environmental, Social and Governance, taking each of those factors and combining it into an investment strategy. And now there's different flavours of these. At one end, you may have what you might call impact investing, which are actively looking for companies which may be focused on renewable energy or whatever it may be. At the other end of the scale, you may have what I may say is a more cynical approach, where you have a restricted list of companies that you don't invest in, and everything else is completely fair game. And I think Mayar's trying to strike a balance there between, we do have a restricted list of stocks that we don't invest in, but sometimes whether something is an ESG stock, whether it's ethical, those lines are a little bit blurred. And so the integrated quantitative and qualitative research that we do into the companies in which we're looking to invest seek in part to come to a determination of whether those ethical ESG qualities are a characteristic of the business that we're looking to invest in. And we also, once we've bought them, continually monitor these. And it's not only doing good, but we think that companies that demonstrate these particular characteristics are much more able to carry on that business model, not attract, say, regulation or legislation to curtail what ultimately drives their returns. And because I think ESG investing has evolved quite significantly over the last few years, where it's moved from an area where I want to feel good about myself, therefore I will give up some returns to invest in businesses of a certain type, to if you are an investor, as we are, who looks for quality businesses that are trading at a discount, part of that understanding of what quality means is do they treat their customers properly? Do they treat their employees fairly? Do they dump poison into river, to give a caricature of that? And once we understand that a company that we're able to invest in and shares the long-term view and values that Mayar has, then that's how we come to understand whether we can invest in a stock or not. And so what does that mean that, what has changed then for all those, since all those years ago where Aziz became a portfolio manager? And the simple answer is nothing. It's just that we're bringing some of that, some of those elements of the investment process much more to the forefront to enable clients to have a much more accurate view of how we invest and then allow us to talk about issues that are important to them in a way that's both credible and authentic. And so you may, those of you who've been following Mayar for a while may see that a more emphasis on these elements, but I can assure you that's really reflecting how we've invested. The track record that we've generated will continue in that way. And so if anyone has any questions about that, I'm open at the end of this, or on email or by phone, whenever you can. If you do have any question about this or any aspect of Mayar, please feel free to contact me. And so with that, I will hand over to Aziz to take you through how the portfolio has performed.
Thank you, Mark. Good afternoon, everyone. I'm thrilled to have you come again for another year. This meeting is, I think we were talking to some of the people even at the venue, and I like, they said this is a reunion, and I like the idea of a reunion. We're partners, we're friends, and we come together every year, and my job is to tell you what we did right, and also to tell you what we didn't do right, and to explain both in a language that I think is understandable to everyone. But more importantly, it's for me an opportunity to both appreciate the partners that I have in you as investors and the partners that I have at the office and the team. And so I would like to thank members of the Mayar Capital team, Aubrey, Mark, Sophie, and Kamea, for everything that they do every day for me as an investor and for me as a manager, because they certainly do make my life easier, they make it better, and they make it more enjoyable. I also would like to especially thank Sophie and Mark for organizing the event this year. I have promised them a few weeks ago when they started not to micromanage the process, which, if you know anything about me, is very hard. And I think that for the most part, you can ask them in private afterwards, I did not. And I tried at least my best not to. And so I am very proud and happy that we can put together all of this with minimal involvement from me. So, of course, the long-term goal for me is to get paid and not do anything. So, performance. So this is a look at how we've done since inception the past 7 years. You've gotten this in your fact sheet, but what I wanted to show, more importantly, is the last one. So since inception, after fees, Class A is up 120% cumulatively. That's over 8 years, with the MSCI up 93% over the same period. What is key here is this 27-point difference was generated by outperforming the benchmark by roughly 2 points every year. So the market did 8%, we did 10, which is pretty much what we did since I was in college, as Mark mentioned earlier. And this idea that I discovered by manipulating numbers in an Excel sheet when I was in college, I found just mind-blowing. The idea that it could do 1 or 2 percentage points better than the benchmark, and then over time see that compounding effect kick in and the spread expand year after year after year. That, to me, the mathematics of it, I found very thrilling, because how you can take something that is relatively small and just like a snowball, have it grow and grow and grow over the power of compounding over time. And that's really what attracted me to the idea of long-term investing. And if you look at any 1 year, I mean, we don't like to think of individual years when we talk about performance, but what I wanted to highlight here is 2018, which I think, 2018 and 2011, if you look at the relative performance of our strategy in those 2 years after fees, you'll see that we've done the most in down periods. And in those 2 down years, 2011, the market was down 10.4, 2018 was down almost 9. We've basically, as much as possible, kept our capital intact, which means that over time that allows us to reinvest our preserved capital at better prices and continue to compound over time. The idea, which is the fourth partnership principle, that you think about risk before return, I think is one of the most underestimated ideas in investing. The idea that you win by not losing. And if that is the only thing that you do, I think over time, as markets zigzag upward, you build that alpha that compounds year after year after year. So when we started out, I told our early investors, and I continue to say that, for me, I'd be very happy if we protected our capital on the downside and just even matched the market or even underperformed a little bit on the upside, because that over time adds up to a very meaningful margin. And likely we've been able to do both. But that's what we wanted to highlight here. Now, a little bit about the past 12 months. We'll look at the kind of contributors and detractors of that performance, because that's a question that comes up. So if you look at, on the positive side, the biggest contributors to performance, we've had MasterCard, Visa, Danone, P&G, and UPS. Aubrey in a little while is going to talk about some of the positions that we currently hold, and is going to touch on a couple of them. But you can see here that the contribution to return has been fairly widely dispersed across the portfolio. And that's not the case when you look at the detractors. If you look at the detractors, basically the biggest detractor has been Nordstrom over the past 12 months. And Aubrey as well, a little bit later, is going to talk about it, and we can go through some of the details in the Q&A section. Now, look at our portfolio at the end of July. Our biggest position is UPS. There's a UPS driver that just parked outside here as we started. I'm not sure if you saw him, but when I see a UPS truck parked somewhere, it brings me a lot of joy, and I feel really nice inside. And to me, the idea that you've got people, this man outside is working for us. As we sit here and we chat, we've got someone who's going to work, and we don't have to do that job because we've got someone who's doing it. So I like the idea of having that going on, 24/7, 365 days a year. The second largest is one of our oldest holding, Alphabet, which is the mother company of Google, which you continue to hold. Richemont is also a company that we've owned for a few years. Richemont, as some of you know, is they own Cartier, Van Cleef, and a host of luxury brands. Discovery, I think we talked about at last annual meeting in more detail, which owns the Discovery Channel. Henkel, Samsung, Essential. I think that was an acquisition last year that we also talked about. And then again, LabCorp is a company that we've owned on and off, well, basically since 2003. And it's one that I've learned a lot from, because the best thing I should have done with it is not do anything. Had I just bought LabCorp as I did in early 2003 and sat on my bottom and done nothing, would have done better than me trying to sell it sometimes and buy it again, but we live and learn. Vestas, again, a recent acquisition over the past year. Aubrey's going to talk about it, and Nordstrom as well at the next slide. Geography, the biggest market is now, continues to be North America. Last year, we talked about how North America has shrunk from being about 80% of our portfolio in 2014 down to the lower 40s last year. It's gone up a little bit this year. That's mainly driven by valuation. A lot of the companies that we like do happen to be listed in the United States specifically, but we do find valuations to be on the higher end there. And so if that continues, you should expect us to continue to be net sellers of US stocks, vice versa in Europe. Cash was at 12% at the end of July, but actually we've been sellers of a few existing positions throughout August. And so actually cash now is more like 18%, a little bit under, I think 17.7 or 17.8 when I checked this morning. So cash has gone up during the month. And we've talked in the past about cash is not something that we decide from a top-down approach. The way we think about cash is the residual, the default position essentially that we put our capital into when our process is generating more sells than buys. So when we're always buying and selling new ideas. If we have a lot of ideas, cash will go down and we put it to work. And if we can't, we're very happy to sell the ideas that we think are overvalued and hold cash until a better opportunity comes along. Top sectors, again, this hasn't changed by much other than the capital goods part, which is mainly driven by the increase by Vestas. Our goal is not, again, to do some kind of top-down. We're not sitting around and trying to decide what our allocation to capital goods should be. It's more driven from the bottom up by the availability of attractive ideas. The only thing that we do impose on a top-down basis here is that we want to be diversified across several industries, and that's just purely from a risk perspective. But we don't decide from a top-down which industries we want to be exposed to. Now, before I hand it over, Aubrey is going to talk about some of our holdings, specifically in more details about a couple. This is a section that we didn't do in the past, and the reason we wanted to do it this year is that what we're trying to do is take some of the principles that we've always talked about and try to find a way to express it in a better way. So we've talked a lot about thinking like business owners and having this ethical owner mindset. And the ultimate end of that is that you as investors in the fund are the ultimate owners of the businesses that the fund owns. And so it is very important for you to know what are the underlying businesses that you're exposed to. And we hope also make decisions based on that. So the next time you want to ship something, choose UPS. Aubrey?
Right, now to show you why analysts should be stuck behind a spreadsheet and not in front of PowerPoint. Okay, Vestas. Okay, they build these massive onshore wind turbines. Actually, slightly bigger than that one. That is a 60-centimeter Lego model. The real things are more like 160 meters, so a little bit shorter than the gherkin and a bit taller than a walkie-talkie, the buildings, that is. I mean, they really are massive. I mean, the blades are something like 50 meters each, so that means the diameter is something like the size of a football pitch. Now, try and imagine actually transporting one of them. See, it can actually take Vestas something like a year just to organize the logistics of getting a blade from factory to the farm. And we think that's a great thing because you take solar. Solar can be shipped from China to England, actually, or Hawaii, where solar works a little bit better, really easily. Whereas you can't ship these things so simply. So you're not going to get Goldwind, the number 2, flooding the market with cheap turbines. Now, Vestas, they are the number 1. They have a 22% market share. And if you look at the number 2 and 3, Goldwind number 2, they're predominantly China, General Electric, predominantly US, whereas Vestas are global. The thing we love about this business, or I love it at any rate, is the service business. Now, it's only about 16% of revenues, but they sign 5 to 30-year contracts. And these are 20 to 30% margin contracts. So these are, enterprise software does not have 30-year contracts. Pity we don't get the multiple that they do, though. But hey, but then the other thing about the service business is that it takes something like 4 years in order to actually receive the first revenue check. From the point you sign your contract, you've got the time it takes to ship it, the time to do all the building, and then you get the free warranty period. So the first year or two, of your wind turbine, you'll have free servicing. So what that means is there's a lot of hidden profitability within Vestas. In the 10 years to 2016, they installed 54 gigawatts. And in the following 3 years, they installed 33. So we can see all that service contracts that are coming through within the next 3 to 4 years, and coming through at 20 to 30% margins. So for us, that's pretty good. Now, what has happened with Vestas? Okay, pricing. I'm afraid to say it has been pretty dire, but it's stabilized. And we could see that it was stabilizing when we looked at the order book. But you see, the thing about pricing is that it's not about revenue. The old adage, revenue is vanity, profit is sanity. The reason prices keep falling is because the costs keep falling. For instance, the new Inventus turbine, which they have just launched, is 30% more efficient. So, they can charge 25% less and still pocket a lot more margin for themselves. But because the costs and the prices do not match, especially with auctions, you do get short-term margin volatility in this business. But, we don't mind that, because whilst prices are declining, the levelized cost of energy has also been declining, as you'd expect. And wind is now the cheapest form of energy. It is cheaper than gas. It is way cheaper than coal. And we believe in 2021 it will be cheaper than existing gas. So at the moment it's cheaper than, to build a wind farm is cheaper than to build a gas turbine. But it's not cheaper than an existing turbine, because obviously, an existing gas station. But in 2021 it should be, with the new developments that we're saying about Inventus and such. And so we don't require green subsidies. We don't require people to want to use wind because they're being green. We just want the economics to play out. And the LCOE does actually include when the wind is not blowing or when the sun is not shining. So this isn't all, as I say, the economics will out. And that's what we're seeing. In the last year, the order book has increased by 38%. Compare that to the 14% CAGR that we've had previously. We believe a lot of that is due to, these falling prices. So yes, we're pretty happy with that, and right. Merlin, okay. They are the second largest theme park operator, second only to Disney. But they're a lot more affordable. Recently took my daughter to Disney, and I'm still, I'm a value investor. God, that hurts. Merlin, on the other hand, they have a wonderful, diverse range of attractions, from Legoland, which is their crown jewel, to the London Dungeons, to Madame Tussauds Sea Life. And these are much more affordable attractions. And I'd say that this is not consumer discretionary. This is a consumer staple. I have a daughter. There is no way I can avoid Legoland at least once a year, or one other of these attractions. Summer holidays are just too long. So they have this diverse portfolio, and it performs well. And because of the diversification they have between indoor, outdoor, geography, across the capex cycle, they don't all do well at the same time. One does badly, but you can take capital from one, reinvest in the other, and it makes a cyclical business relatively stable. Now, what's happened? This has been a roller coaster of an investment. I'm sorry. About 6 months ago, Value Act come in, and they go, share price is too cheap. Well, we think management should take it private. Okay. Several months later, management agree. And they come up with this lowball bid from Kirkby, who are the Lego family and the 29% shareholder, Blackstone and CPP. Now look, I can't blame CPP for being a good value investor. Yes, we think it's a lowball bid, and that in itself. The thing that does stick in the throat a little bit is the question of independence. So obviously Kirkby, being the major shareholder and owner of Lego, have good insight into the business that the rest of the city does not. The fact that the chairman was there when Blackstone last owned it. The senior non-independent director was actually appointed by Blackstone, and this is the guy that recommends to shareholders that we should accept this lowball offer. Anyhow, sorry, I could rant about that, but yes, we've done well out of it, but I now have to go and do some more work and find some other great businesses. Right, Dunelm. Okay, so we're in the middle of a retail apocalypse, so why do we own retail? And the thing is, we are still seeking quality. We haven't lowered our quality bar. And it is harder to find quality in retail these days, but there are still pockets, places where you can find some niche business that still has the quality that meets our threshold and, also got sold off. So Dunelm are the leading UK homeware store. They have about a 6 to 8% market share, and that means it's a pretty fragmented market. And that's great because they have a massive cost advantage as a result. So many mum and pop shops, smaller stores, that just cannot compete, with the scale leader. Now, they have a specific focus on things like blinds and curtains, and these they will do to custom sizes, which in the UK with non-standard windows and ceilings is actually really quite a big differentiator. And now, yes, you can find stores online, but it's going to be quite a premium. Then the other thing they sell are things like Tupperware, kitchen essentials, utensils, and other such essential things that I didn't realize were so essential until I took my wife on a research trip to Dunelm. And that was actually quite expensive. I didn't know how many, well, yes. But what I found so extraordinary was that they are able to undercut Amazon on so many things. I bought a suitcase, which was like 20 quid cheaper than I could have got it on Amazon. The Tupperware my wife bought was, again, like 20% cheaper. And of course, that's because they operate out of these big box retail, where rent is something like £5–10 a square foot. And when you're shipping something that's fairly low value but fairly bulky, you just can't do that economically. So they are able to outperform. And then one of the other things we like about it is that they have a very long maturation period. So there's a C-level exec at one of the leading retailers, UK retailers, and he was telling me that their homeware section can take something like 3 to 4 years to reach maturity. And that he often sees competing stores, homeware stores, nearby him just flounder and fail because they can't withstand that level of pain. So that's one thing that sort of moat that we really like with Dunelm, but also it means that all the new build stores they have are under-earning. So again, you have this element of hidden profitability that if you can extend your time horizon to see these stores mature, you actually see the profitability increase without having to do a huge amount of work. Now, what's happened with Dunelm? Okay, so 2017 was a bit of a nightmare. Obviously, a lot of Brexit turmoil. Housing transactions had just fallen off a cliff. But you see, people will still replace blinds and whatever, but moving house is that catalyst. So you just delay it a little bit, which is sort of what we saw in 2017. But we've seen growth pick up quite significantly. Same-store sales have been excellent. This has been helped also by a mean reversion of mortgage approvals. And actually last month, July, was the highest UK's had in 10 years. But the thing we really like is that they've been taking share. In this chart, you can see their growth compared to the market. And again, that just is testament to the fact they have this massive cost structural advantage, where they're able to sell better quality for less cost, which is something we like. So The business we think is still positioned well. They've grown online sales in the mid-30s, which is now 16% sales, and we're certainly happy with the business. Right, final company I want to talk to you about, Nordstrom. Yeah, that's been painful. Now, admittedly, one of the reasons is that it was about a year ago that management wanted to take the company private, but that bid was rejected. And as you can imagine, the share price has reacted. But there has been weakness as well, which I'll get to in a second. So Nordstrom, they sell apparel, women's apparel, shoes, men's apparel. You can see the breakdown of sales there. But these are much more upmarket than the competition. And you look at their demographics, and they have the youngest demographics of all their competitors, and they have the highest income. But also what we like is they have invested much more into their stores and into online. I mean, online is now 30% of sales, or a little bit more. Right. But what we have seen is recent weakness in same-store sales. And where is this weakness coming from? Well, part of it, yes, Amazon, online, but again, they have a big online presence, so they're doing well out of that. Discounting, has hurt, but they have, really good discounting off-price range. But then, one of the other things we've seen is that in 1975, the personal savings rate was 12.5% of personal income. People were saving 12.5%. And that declined to 2.5% in 2005. But since then, it's gone from 2.5% to 7.5%, 8%. And you just look at that and think that has to be a headwind. And it's not just that headwind of people saving more. It's also the mentality behind that. People are becoming more frugal. But this is a trend that cannot go on forever. You cannot keep saving more and more of your income. As much as I'd like to, I cannot save 100% of my income. My wife won't let me. So the question for us really is, how are they positioned? When we do see mean reversion, or even if not mean reversion, even if these headwinds just abate, how are they positioned for this? And the answer is actually really well. See, in this chart here, see the red is their capex minus depreciation divided by sales, and compare that to the competition. So basically, Nordstrom have been over-investing. They have been investing for growth, whereas the competition have been consistently under-investing since 2009. They've been squeezing their businesses for cash. And that's why I've got the rather cheeky picture of the tired-looking Macy's there. Because this is how you become a category killer. By investing when everyone else is squeezing their business for cash, when everyone else is really tightening their belt, and you're able to invest, that is where you can position yourself to be a category killer. And what we're seeing is that capacity is now being taken out of the industry. We're seeing other people shut down stores like that, which means that when we do have that mean reversion, Nordstrom are positioned to be a winner. And again, this is just another example of extending your time horizon by looking past the short-term volatility of seasonal and quarterly sales numbers, and looked just a few years out. That is where the opportunity lies. Thank you.
There are a couple of things. There's one thing that Aubrey failed to mention about Mayar. So apparently the Queen buys her Tupperware there. And I figure with all the banquets going on, there's got to be a lot of leftovers, a lot of Tupperware to be bought. So that's a captive audience of customers there. I think Aubrey mentioned it again, but I want to re-emphasize. There is a common thread to everything that we do in terms of what we find attractive. I think the idea that value investing is about buying something that trades at 10 times earnings or whatever, those days are gone. They've gone for a while. A lot of what we have to do today is try and find hidden value. Aubrey used that word a few times. And perhaps the biggest advantage that we have, I'd like to say, is our brilliance. But the reality is, I think our biggest advantage is the ability, structurally and psychologically, to have a much longer investment horizon than the person who's trading against us when we buy or sell something. And so it's a fancy word, time horizon arbitrage, but that's basically what we're doing. We have an asset that the average person does not, and that is the ability to look forward 1, 5, 10 years down the road and base decisions on that horizon. While the average investor, I think the average holding in the New York Stock Exchange was a peak of 10% in the 60s. Was as short as 10 years in the 60s was as short as 1 year in the 90s, and now it's 3 months. And so if the average person you're sitting across trading those securities only cares about the next 3 months, you're both being rational in that transaction. You just have different goals, and our goal is to make money over the long run. And so a lot of the time, it is like Danelm, like Merlin, like Vestas. We want to find companies that are at least optically under-earning. And we know there's hidden profitability in there where we know it's there. We're not making assumptions about potential profitability. Those are actual numbers that are there. It's just an issue of basically bringing them out to the surface.
Okay.
Mark?
Yeah, thank you, Aziz and Aubrey, and we hope you've got a good overview about what we're trying to do from a strategic point of view and some of the holdings in the portfolio today. We asked for some questions ahead of time. Some of you were kind enough to email them in, and we've tried to put them under various headings where there are similar questions. But if you don't feel yours were answered or one occurs to you in the next couple of minutes, please feel free to put your hand up, and Sophie will come around with a microphone so we can all hear. I'm going to start off with one of the email ones to give everyone a little bit of
Send the hard ones to Aubrey.
Okay. So Aubrey, this one's for you.
Thank you.
So you may have seen that the yield curve in the US has gone negative recently, and this is regarded as a pretty reliable indicator of an impending recession. If that were to materialise, how would that affect Mayar fund performance?
Yes, well, I consulted the Harris specs yesterday, and we tossed a coin over it. I mean, look, we try not to make big macro calls, and looking at the yield curve can be very interesting, but it's not really going to tell me much about the hidden profitability of Vestas, whether, and again, we look for the long term. If the market falls, great, we're going to find some great opportunities. It can get quite frustrating at the moment when valuations are quite high, and you see so many stocks that you really want to own, but they're just too expensive. You look at the cheap stocks and you just go, okay, really, I do not want to own them. I do not want to own plus 500. I want quality, but they're at prices we can't afford. And if the market sells off for whatever reason, whether it's because the geese fly south or the yield curve inverts, that's an opportunity for us.
Okay, and so we've been mentioning we look ahead 5 years. One of the questions we've got is, what is your forecast for global stock markets over the next 5 years?
I think they will fluctuate.
Yeah, I mean, it is a question that we get fairly often, I would say. But what's your forecast, either from a macro or a micro point of view, over a much longer period of time? And, of course, we'll go back to that false confidence of a precision. We think the market will be up 32.8% over the next 5 years. And you can walk away saying, oh, that sounded like a very accurate prediction. But the fact is that we don't know. We don't claim to know either. And so the philosophy and the process that we've developed over since Aziz to invest is to try and take those fluctuations out of our thinking and think much more about how will this business drive returns over the long term, and whether that is realised on the 24th of February 2025 or 6:30 in 6 months' time is largely irrelevant to us. We're looking for quality businesses that we can own at a discount that can drive returns for the fund, for you, our partners, over time.
I think there's another thing, and I think Howard Marks puts it best. So, to be able to make money from a macro prediction, 3 conditions need to be met. The first condition is you have to be right, which is very hard to start with. The second condition, you have to be different. If everybody knows something, then it's already in the price, and there's no money to be made by discovering it. And that's also difficult. And the third thing is you need to be able to express that contrarian and correct opinion in a way that directly links what you invest in and your opinion. And that's also hard. And so doing all 3 consistently has proven through history to be very difficult. I'm not saying that nobody can do it. I'm just saying that we can't.
Okay. We've seen the performance over a much longer period of time there, and we have been able to preserve capital during down markets. What techniques have you used? Do you use short selling, for instance?
We don't. I think preserving capital is something that is just a byproduct of our process. Part of it comes from the tendency of essentially our process to spit out more sell signals than buy signals when the market is high, which means you see our cash go up when the market is expensive, and you see us being fully invested when the market is cheaper. And there is an inadvertent kind of counter-cyclical element to the cash. But actually, if you do attribution analysis on our performance, that historically has only been about 1/3 or less of the outperformance in down periods. I think it has more to do with our conservative approach to valuation and the conservative approach in selecting the types of businesses that we invest in. The reality is, and history shows that there is a link between the volatility of the stock and the volatility of the business. And if you do buy businesses that are more resilient, if you do buy businesses like we do that have much stronger balance sheets than average, then they do seem to hold up better in down periods. And you do end up protecting your capital to some degree. Now, I don't have anything personally against short selling in principle, but I think given our time horizon, our skill set, at least for me, I'm much more comfortable thinking of businesses that I want to own for 5-10 years than trying to predict what's going to happen in the near term.
So I'm going to combine these two. How does becoming a UN Principles of Responsible Investing signatory change the way you invest? And what's the difference between that, say, ESG, ethical investing, whatever label you want to put on those things?
Sure. Let me take the second one first. I will admit, and Mark will disagree with me, I don't like the label ESG. I don't like labels in general. I think, to me, there are things that are the right thing to do, at least from my perspective, and kind of my moral values, and there are things that I find to be wrong. And as an investor who thinks about businesses as a partnership between me and management, I think that is imperative and just completely logical that we share similar values. And so for me, the idea of ethical is just natural, just more encompassing than the ESG label. But part of it is that I'm just naturally cynical as a person. And when I see ESG, I think of someone at a big investment house with a checklist trying to make investments in a way not to maximize returns, but to maximize AUM. And so I think in a perfect world, they should be one and the same. In reality, some people doing ESG today are doing things for the wrong reason. To me, ethical is the overarching reason of doing things, not because it's fancy or popular today. The UNPRI thing it's actually something that I haven't heard about until a couple of years ago. Had I known earlier, would have done it then. So we became a signatory on the principles of responsible investment earlier this year. And it's a set of 6 principles that basically, where you basically promise to incorporate ESG factors into your investment process. And the reason I found it attractive is we've had to change nothing. We haven't had to change anything in the way we do things. We haven't changed anything in our checklists. We haven't changed anything in the types of businesses we look at. We've always been doing this. And when the opportunity presented itself to become a signatory, we jumped on it. And the reason we jumped on it is that it's a signaling mechanism to our investors that we're really serious about this. So it's one thing, especially in the early days, a lot of people invested with us because they knew me on a personal level. And as we've grown, we have a lot more people who don't know me beforehand. So I think the importance of signaling becomes bigger and bigger over time, and doing something that shows people that we're serious about it is very important. There's a question, I think.
Thank you, Mark. So first of all, great to see the team expanding, and it's really impressive what we've seen here. And I've been witnessing Mayar's story for a long time. I actually have 2 questions. One is, what's the best decision you've made that you really regret, and the worst decision you've made that you're really happy about? So I think this is the first one. The second question is, how much time do you spend per portfolio company before or during you invest in it? So these are my 2 questions.
Okay, let me answer the second one. Well, you want to answer the second one? While I think about the first one.
Well, I was actually just thinking about the first one, because
that's a very hard one.
You'll need to repeat the second one.
So the second one is, how much time do you spend on a portfolio company before it becomes a portfolio company, right? And then after.
Okay, so that can vary hugely. So you take a stock like Lindy, when we bought that, and that didn't take very long at all. And the reason for that was that in my old job at Odias, I covered chemicals and software, and I'd spent quite a lot of time on the industrial gases. So, when I'm here at Mayar, Lindy fell to really attractive levels. It was really simple. It was because I knew an awful lot about it already. You take Vestas, may have spent.
We spent a lot of time on Vestas.
A lot of time.
Versus a P&G, which.
Yeah. It's really hard. It's a couple of months, but it's not solidly, on that. It's, because you dip in and out, and, you come across something that you don't understand, and, you then just have to think about it. And sometimes you might stop looking at it for a week whilst it just sort of percolates at the back of your head. And then all of a sudden you have a light bulb moment. Yes, I get that bit. But for something like Vestas, that was something I'd never looked at before. I'd never looked at the wind turbine industry, one of the stocks I'm looking at the moment. So, again, is something that I've never looked at before. So it's taking a much longer time. But, other stocks can be pretty quick if, when you know the industry really well, when you know the company itself.
Yeah, it's essentially a function of 2 things. How familiar we are with the industry or company. And the other thing is the difficulty of the factors that's causing it to be cheap at the moment that we're looking at it. So the first part is, you can think of it of circles of competence, and at some point if it gets too far, we never invest because it's just outside our circle. But for example, when we bought P&G early last year, we owned a lot of companies in the industry at the same time. So we were following P&G closely because we also own some of their competitors like Unilever and Henkel. So and it's a company that I've followed for many, many years. So it was just an issue of the latter. Is the issue, are the temporary conditions that have caused the stock to get cheap actually temporary or not? And it wasn't as hard of a question to answer because of our knowledge of the industry. And then you take, like Aubrey said, the situation of Vestas, where it's an industry that we didn't know. And so we spent a lot more time on the industry and the company. Often we are 80% comfortable with an idea, and we spend days, weeks trying to answer one or two questions. I would say most investments, in the end, it comes down to a couple of questions that are key. And if we can answer them, we can make a decision. Most of the other stuff is just collecting information and just dotting I's and crossing T's. It usually does come down to a couple of things that are that need to be answered. And if we can't answer them, we don't invest. And there's a lot of back and forth and playing devil's advocate with each other. That kind of takes time and a lot of burritos. But we do discuss ideas over burritos. It's a thing we do. The other question, it's the best decision that I regret and the worst decision that I don't.
That you're really happy about.
Ooh.
So good decision, bad outcome, bad decision.
Oh. Mm. Oof. Can you think of
You can
something?
answer the reception.
Well, I think, I think Nordstrom is a good decision, but the outcome has been,
Yeah.
pretty bad so far.
And then, especially with the buyout. So Nordstrom is one where, so we started buying it in the high 30s. It went up all the way, what was the offer price, 80? No,
No, 50.
50. Or
So
thereabouts.
touchdown at 48.
Anyway, we bought it, it went up. The family made an offer, and we thought it was worth a lot more than the offer price. It never got to a vote, but if we did vote, we would have voted no. And in hindsight, the stock since then went down a lot by 40-something%. Obviously, I think we still hold it, so in the short term hasn't worked out. So clearly, if you talk about short-term regrets, yeah, it would have been nice if we'd sold it to them then. We still think it's worth a lot more, but that's one where I think, like Aubrey said, it's the right decision, but the wrong outcome. The other one was the
Worst decision that you're most pleased about? I think that's the hardest to answer because it's very hard to, when things go right, it's much harder to do a post-mortem.
Is it an investment? Does it have to be an investment? Because I have one that's not an investment. Yeah, I think building Mayar the way I did. I think in retrospect, I did a lot of things that were unnecessarily hard. I chose the hardest path every step of the way. And it didn't, and at every point in time, it was probably the wrong decision. And looking back, by luck, things worked out. I don't know if it was the right decision. It probably wasn't a priori. It could have gone horribly wrong at many points. So that's one that's worked out. That probably wasn't very smart. It was needless pain and suffering. I used to have long and flowing hair, by the way.
I have a question on Nordstrom, because this is a classic dilemma for a fund manager. As it goes down, you're probably asking yourself, are we right, wrong, should we add more? How do you deal with a position like this, going down, giving you such underperformance? And do you put a fixed limit in terms of portfolio weight that you say, okay, I'm not going to go over that? Yeah, I guess Nordstrom is a clear example for this.
Yeah, I mean, we kept buying on the way down. There's a chart. I haven't put it up. But I mean, we've actually owned Nordstrom off and on since 2006. It was a very high single-digit percentage at some point, and it was as low as below 1%. And if you plot the two, it was basically an inverse relationship between price and position size. And a lot of the companies that we own will do that, where throughout a period of holding them, we may not change our opinion about the fundamentals, but we change our opinion about the valuation, especially relative to other opportunities. And we'll buy or sell based on that. And then a year ago, you see that break in the case of Nordstrom, where the stock went down and we continued to add, but then we stopped. And the reason we stopped is, like you said, you have to put a cap on position size. And we usually want to be around 5% of capital, but you can't keep chasing it, and as it goes down, you can keep putting money into an ever declining position size. So we cap it. Roughly, we try to be 5% of capital before the move in the stock, essentially, as the cap going in, and we let it run up a little bit more if it's gains, but we won't add more money into it as it goes down. I mean, time will tell whether this one is going to work out or not. We do think that the odds are significantly in our favor, but we'll report in 5 years or so, and if it didn't work out, we'll try to say why. But.
So I have two questions. One backing on to Nordstrom. So I think the case seemed to be already that there was the capex, that they're outspending other people. So when people are not spending, presumably they'll be the last man standing and they'll be the category killer. But the question then is, what are they spending on? And so have you seen any evidence of that category killer emerging? And my second question was more to see how you deal with the subject that I'm dealing with right now, which is when you like something, but you're still doing work on it, and the stock starts to move, what do you do?
Okay, Aubrey, you wanna take the first one about Nordstrom?
Yeah.
CapEx?
Okay, so what are they spending on? Well, one of the big things that they're spending on is online. And we are seeing phenomenal growth there, and as I said, it's now a third of sales. So we're starting to see that come to fruition. And obviously now it is such a bigger part, it can have a much more meaningful contribution. But then the other thing is there are new stores. There's the New York store. They're also trying out a lot of things with multi-channel, and we quite like this because I think sometimes you have to experiment. So they're trying out some really small format stores where you can order online, order on your iPad, go in, try it on, leave the ones you don't like, take the ones you do. Because one of the big killers to online sales is not just the delivery, but returns. Because it's become such a trend now that you order 2 items, 2 coats, exactly the same. One size 44, one size 42, and I send back the 44 because and that really can kill your margins for an online business. So if you can try and find some way of getting around that, you can really improve your online margins. And so trying things like that, I think, could be really good for them.
Yeah, I think so Nordstrom, what attracted me to what they were doing, and we spoke about this in the past, is that they were very way ahead of the curve in terms of investing in online, and they've built their infrastructure essentially with that in mind. And the thing with all infrastructure, but retail infrastructure is a difficult one. It's hard to switch it after the fact. So you see a lot of other retailers still struggling with the ability to fulfill orders from a store instead of a warehouse, and then making sure the warehouse ships that item back to the store so the store is always in stock. But like Aubrey mentioned, the experimentation, Nordstrom last year rolled out, they've been early, obviously, like everybody else, in order online, pick up in store. But then they did something which I think is the impotence to to this latest Nordstrom local concept, which is order online, try in store. So you order online, and then you go and you say, let's say you're ordering from Selfridges, and you say, I want a jacket, and they'll say, okay, go. Here's a slot about 4:30 p.m. Selfridges on Oxford. Go to the second floor, changing room number 2, and you walk in and you'll see your jacket plus a size bigger and a size smaller, and you try it out, and then you walk out with the one that you like. And once they did that, they took that now and started this Nordstrom local, where they're essentially taking that changing room and putting it in local neighborhoods to kind of shrink the distance that the customer needs to travel to get there. And like Orbi said, it has the benefit specifically on the return side in terms of costs of shipping, but also on the way out, because one of the hidden costs of shipping 2 jackets instead of 1 is that you now have to have twice the amount of inventory on hand if everybody's buying 2 instead of 1, while that inventory is in going to or coming back from a customer. And so you can have higher inventory turnover if you can solve that problem. And one of the early, again, it's very early days in terms of the Nordstrom local concept. They've only had it in LA. They're opening them now in New York. But it seems that a significant percentage, there's some evidence that might be a third, will either buy online, buy and try in the shop, or at least return to the local shop instead of ship back. It kind of helps the logistics as well. So the logistics, I think, are one problem that is a problem that needs to be solved, that people who are only focused on maximizing sales are not thinking as hard about. And I think Nordstrom's physical infrastructure being well-placed and profitable gives them an edge over some of their competitors that have expanded into Class B malls and have too many, they're overstored essentially, and need to kill a lot of those stores. There was a second question.
Second part, no FOMO. What do you do when an idea is running away from you?
Yeah. Well, I mean, I would say that if it's an idea in an industry, for example, that's new, or a company that we haven't looked at before, as a rule, we never buy a full position to start with anyway. So we'll always start with a 2.5% position in that case after we are comfortable with it. And then it will build up over time as we become more comfortable. Vestas is a perfect example. So we started buying Vestas once, let's say we were, 80% comfortable. And we were never 100% comfortable. But once we became 90% comfortable, a few months later, we bought the second half and built it to a full position. So we will do that. But the threshold for the first one is relatively high. And that means that we will miss some ideas. But in my experience, the first time you come across an idea, it's usually not cheap. At least the ideas that because we're always screening for businesses that we want to own first and evaluation second. And so we come across companies that we like and then try to figure out whether the price is right at that moment. And so the odds are, on average, because the market is fairly efficient, they're not going to be cheap when we first look at them. So it's very rare that we look at something and we like it and it's cheap and it goes up immediately afterwards. But sometimes it does happen. There was one case where right before we bought, there was an acquisition offer, so a few years ago. So it will happen sometimes. But like everything else in what we do, it's very important, like Corby said, not to have no FOMO, no fear of missing out. We've got stickers on our computers that say no FOMO. You're going to miss some, but that's the price to pay to avoid the mistakes.
What you just described is very interesting because you like good business, but you think the price is too high. But then if the price falls, at that point, do you say it's not a good business?
No?
Or is there a tendency then to be, well, maybe it'll fall further, or maybe this business is now going down? How do you overcome that, those are behavioral issues.
I think one of the questions is, why is it falling? You just have to answer why. Is it? And if you don't know why stock's falling, then you probably don't know it well enough. Yeah. I mean, if you see a stock fall 30% whilst the market's up 10, and you can't tell me why it's down 30, I'm not going to want to own it. Yeah, if you can say, okay, I think it's falling because of X, Y, and Z, and actually I think this is a temporary issue, that's when we can have the confidence. Yeah, but also in answer to your question, one thing I was told, I remember, my last time getting really upset that the stock I was looking at was up 5% and then it was up 10%. And Patrick he just said to me and said, look, Ori, you think this stock is worth, 500p, and it's now 200 and something. Why are you getting worried about another 10%? Just calm down. Now, spend a bit more time on this and have a few late nights if you want to, but just keep calm. I think that's one thing you have to just always remember.
I think in terms of bias, I'd rather look at something for the first time when it's not cheap. So if I look at something and say it's trading at $50 a share and we do the work and we think it's worth $50 a share plus or minus 5, we won't buy it. But we now have a price that we can track and we can put it in our Bloomberg monitors and we can follow it over time. And then an adverse event happens and the stock goes down from 50 to 40. Now our job now is to answer one question really. Is this adverse event worth $10 a share or is it worth 5 or 15? And often the market, but not always, but often the market will sell it to 40 and actually now it's not worth 50, it's actually worth 45. But now there is a margin of safety where you can buy it. That being said, in my experience, averaging up has always yielded better outcomes for us than averaging down. Some of the holdings that we've owned for 8, 10 years, we've bought them as they've gone up and we've done much better there than trying to average down. But we are value investors, so we do like buying things on sale.
Hi, you mentioned that you're holding more cash now. I was wondering, what's the highest cash balance you've had, and do you have a good list of buy candidates? Are you likely to be holding cash for a while, or do you have your eye on something?
So the highest cash balance we ever had was just under 23%, and that was beginning of October last year. And then the market started to fall, and we always have ideas that we want to buy and own for a long time, but they're not at the right price. And so once the market started to go down, some of the ideas went down, obviously, and we started to buy. And I think by December, we were down to about 10% or 12%. And the market continued to fall. And then in the last week, so basically, I remember putting in the trades in our sheet on Christmas Day. We turned over, it was 15 or 17% gross. We sold some things and we bought 15 or 17% of our net assets essentially in one day. Some of them took a couple of days to be filled. And so we ended the year essentially at zero. In my experience, our cash moves upwards slowly and moves down very quickly. When there is panic, when there are opportunities, we are ready to act, and we usually act with swiftness and we act with confidence. And as you see, I mean, we started with zero, now we're up to 18% during this year. So we've come almost full circle. But yeah, I mean, I think since inception Mark may know this number, top of, I think weighted average cash is 6 or 7%. Yeah. We don't usually have a lot of cash on hand, but we do when we feel that future opportunities are better than today's opportunities. I mean, our pipeline is a function of companies that we like, and we've got a few. I mean, you can see them here, but they're not cheap.
We're not going to show you that list.
But yeah, I mean, our job is essentially to keep adding companies to that pipeline and assigning a price to them, and then following them over time. Some will drop because we don't like them for one reason or the other over time. But it's basically having this wish list of, I mean, my son is really into Lego. And he has a wish list of Lego sets that he wants to buy on his birthday, on Eid, on Christmas. Every event in the calendar, he has a plan and a budget for it. And we basically do the same thing, except we're too shy to buy Lego. We really want to, but so we end up buying stocks. Well, Aubrey can tell you about how a Lego set inspired one of our best performing investments.
Well, it was, I mean, that wind turbine. I was looking for a new set for my daughter, who also absolutely loves Lego. And it came across this turbine. So how? Vestas, I know that name. Where do I know that? You know, put it into Bloomberg, and okay, interesting. So what? Okay, 8 times earnings, right. So yeah, I got rather interested. But just through wanting to buy Lego. Now, you know, that was then Mayar's Christmas present to Florrie for doing that. And you know, age 5, she put it together in a whole day. Which,
we're thinking of changing the Brockle Bank on payroll.
Well, she's certainly the smarter one, and more emotionally mature.
Any other questions from the floor at the moment? You've mentioned a few times actually about how we identify as a value strategy. But if you look at the fact sheet, there's a style box that Morningstar and their wisdom put together, and it's more in the sort of blend, sometimes in the growth sector. How do we reconcile that particular difference?
I think it's just a way, not just Morningstar, but in general, index providers and everybody, they need a simple way to define value, growth, blend, cap size, whatever, something that is objective in a way that it can also be run on a computer very easily. And so what they end up doing is looking at something like the bottom half of PE ratios in the index, or the price to book, or whatever. And they say anything that's at the bottom 50% is value, and I think the top 50% is growth. What we do is different, and the reason, I mean, we said that earlier. I think the idea of buying something on a low multiple, I don't think works as well as it used to. You need to find something that is low on a multiple, but where the E in the PE, for example, is not showing optically the way it should. And some of the things that we discussed when Aubrey was speaking about heading earning power, I think is key. It's computers, I think, have arbitraged away a lot of those low multiple opportunities. The other way of thinking about it is the way I think about shopping. And there are 2 ways to shop, let's say for apparel. The first way, which we prefer, most people did, is to go to a Nordstrom full-line store, have amazing service, pay full price for the item, and walk out happy and satisfied. And that would please us very much. But life has people like me who prefer to go to the Nordstrom Rack, which is their off-price store. And there you'll buy the same quality items, maybe off-season, or a season older, but you'll buy them at 40, 50% cheaper. And the reality is, not with the Rack, but in general with those off-price stores and outlet malls in general, most of the stuff in the stores is crap. And so to find hidden gems requires you to go and just run through things. And usually there's one person in the shop, and they're not going to help you because they're checking out everybody else who wants to pay. And it requires a lot of effort to dig through the rebel of those discarded jeans. And you'll find one there if you put in the effort that is half price. And when you buy it, to me, you're a value investor. So it's the same, I don't know, 7 jeans that you could have bought from the full line store. But now it's 50% cheaper and it's the exact same pair. And that, to me, that is the difference between value. It has nothing to do with the quality of the item, whether it's growing quickly or not. If it's growing quickly, then it's worth a lot more. But to say that buying, so we bought Visa at 16 times earnings in 2011, and we bought MasterCard actually at 18, a little bit after that. And that wouldn't fit the optical value. But here's a company that's growing high 20% a year with visibility out. I mean, at the time, the visibility was 20 years. Maybe now it's shorter. We've got a lot of visibility. And so the growth part of it there, this is a company that's probably worth 30 times earnings that you're buying at 16. To me, that is your margin of safety. That's value, as opposed to buying a company that's declining at 12 times earnings and it's actually worth 10.
Okay, I think we're moving on to a section of questions that, given the timing and the tone of them, may have been prompted by headlines about a higher profile UK fund manager. We'll try not to mention that company by name, but it's a little bit more about the portfolio and some of the monitoring really that we do. So we run a particularly concentrated portfolio, but between 20, 35 stocks. We've been at the lower end of that for some time. So how do we make sure the fund is adequately diversified with such a concentrated portfolio?
So one thing that we report every quarter is look through revenues for our portfolio, and that's in every quarterly letter that we send out. And what we do basically is we think if we owned all these businesses in the same weights that they are and consolidated them, so the revenues from Unilever selling shampoo in India or UPS shipping something to Brazil, if we bring all of these revenues in and consolidate them as if we're one big conglomerate that owns all of these businesses, what kind of geographic exposure will we have as an owner, as a business owner? And that's how we think about exposure, because we're going to own these things for many, many years. And the stock price will move a little bit up or down in a direction that's different from the fundamentals in the short term. But over long periods of time, the stocks will follow the fundamentals. And so we'll look at the fundamentals and think about it in a more longer horizon way. And then we'll do 2 things. Are we betting without knowing on a geography that we shouldn't be betting on because it's a small percentage of global GDP, but I don't know, let's say we have 10% exposure to it. We don't want that because we can't know that much about it to be able to make that big of a bet. So we want to be broadly diversified in terms of geography. And then we want to do the exact same thing with industries. Over long periods of time, we don't know which industries are going to do better than others. And so we just want to be broadly diversified between a handful of industries. And then if you run the numbers statistically in terms of the benefits of diversification, the number of companies that you need to own to capture the overwhelming bulk of the benefits is fairly low. I mean, even with 10 positions, if you design a portfolio well, you can be fairly diversified across industries and geographies, and you'll do well from that perspective.
We saw some of the financials in Aubrey's section there that are forecasting out a few years. What sanity checks do we conduct to check our assumptions that go into the production of those numbers?
Aubrey, you want to take that?
Checks. Well, I mean, I guess the first thing is, you try and start with the base rate. What's that book? Super Forecasters. Highly recommend that to anyone. But one of the things you've got to start doing is think. Let's do it with Visa and Mastercard. Okay, so we know GDP is 2-3%, and let's just use some fake numbers for the moment. Cash as a percentage of cash usage is, let's say, 20%, but we think it's going to be 40%. Well, then that you're going to double. So you've got GDP plus the doubling of electronic. Sorry, yeah. And then you factor in, market share. Now, we don't take deterministic ranges either. We don't sort of go, okay, it's going to be this. We'll say, what if it's between this and this? What if it's between this and this? And then actually we can use a computer and simulate everything that comes between them. We'll sort of get a nice distribution curve of what we think outcomes might be, and we'll then discuss it. Say, does this seem reasonable? Are we looking at a sensible range here? But then throughout the valuation process, there are a lot of sanity checks that come out. So, one thing, as I say, we have this sort of simulation, but we put our ranges in. We simulate every outcome in between, and we'll then see not just ranges of valuations, but what sort of standard deviation of valuation we have. If our standard deviation of value is way more than the market, we're going to go, okay, hang on, we're not very certain on this stock, are we? So we're probably going to need a greater margin of safety. We can also take the correlation of value to driver, which will then give us how sensitive is the valuation to certain drivers. Sometimes the results can be surprising. We go, oh, actually, hang on, this business is much more sensitive to asset terms. And that can then help us to focus on what is sensitive, on where the greater sensitivities lie. And I think those are some pretty useful sanity checks.
Yeah. I think more than anything, which we do with valuation by looking at history and how whatever parameters that we ended up agreeing on fits with history. On a fundamental level, I think everything that we assume has to be around the base rate, whether it's margin, sales growth, whatever. And then also need to have work in history. Otherwise, we need to explain. What we will do is we'll put down oral assumptions, basically. And if they are in line with the base rate, they're in line with history, then the issue may not be in us assuming something completely out of whack. So I think that's the first cut. You want to make sure you know what you're actually assuming in the decision, because often people implicitly assume things and not know it. So when Aubrey talked about the sensitivities of assumptions, I think that one particularly is key, because if it turns out that, I don't know, XYZ company is very sensitive in how we valued it to asset turns, and we look at the past, and like asset turns are all over the place, and we have no reason to be able to predict asset turns better than the average person, then we can't own that stock. It's often figuring out what is it that you don't know that matters the most.
Okay. Now this time we really are bumping up against the time limit. So if you do have any questions, it's great for us all to get together and try and deal with these questions in one go. But please, our door is always open if you have any other questions that you'd like to direct towards me or towards Raziz, who then forward it on to me and I'll answer and send it back to him. But we want to keep the dialogue and the information as open as we can, and to a large extent that's our role. And part of our founding principles, the Mayar principles of straight talk, as well.
And
So-
honestly, Mark comes to the office every morning, sits in front of the phone looking like this, waiting for someone to call him. And so please do call him with questions. He's can get lonely.
Yeah, please do.
Thank you all for coming. I really appreciate it. And thank you for your support. Thank you for your trust in us. We view ourselves as custodians of your assets, and we continue to promise you to treat them as if their own in a good way. And yeah, thank you for showing up today. I hope we change the time this year, so we'd also appreciate if you give us some feedback, if you prefer the morning or the afternoon like we did, or if you prefer, we did it a Wednesday this time instead of the usual Friday. We appreciate all that feedback. It helps us basically accommodate as many people as possible. Enjoy the rest of your evening.